My name is Jeffrey Kennedy, and welcome to Trader's Classroom. And welcome to the last class we're going to have on Fibonacci analysis. Not forever, but just for the time being. As you know, over the last few weeks, we've been extensively studying Fibonacci analysis, different ways to actually calculate Fibonacci retracements, Fibonacci multiples. We even looked at Fibonacci dividers, and even spent a little bit of time discussing Fibonacci time analysis. Well, today we're going to wrap up our series on Fibonacci analysis, and what I'm going to be doing today is actually sharing with you a technique that I call reverse Fibonacci that I developed really more than a decade ago. So that's what we're going to be doing today. Let's get started. Now, if we look at a basic Elliott wave move, this is an impulsive structure, a five-wave move, one of the two types of motive waves, the other being an ending diagonal. These are the most common relationships we look for as Elliotticians, and we've discussed this extensively, I believe, in the first class. For example, the most common Fibonacci retracement for wave 2 is a 618 multiple of wave 1. Ideally, we'll see wave 3 travel to a 1.618 multiple of wave 3. Wave 4, well, wave 4 is going to fall back to a 0.382 multiple. In fact, let me go ahead and put that on the chart. Just go ahead and put that up there quickly. The most common Fibonacci retracement for wave 4 is a 0.382 multiple of wave 3. And then typically whenever it comes to the fifth wave price move, that's when we're looking for wave 5 to equal the distance traveled in wave 1. But also, if you recall from many of our lessons, these numbers here, these calculations, these are the ideal. Remember, we have a number of Fibonacci relationships we actually look for example, on the pullback in wave 2. On some instances, you'll see a very shallow wave 2, and it comes back to a 382 multiple of wave 1. So let's go ahead and put that line here. And then sometimes you'll see a wave 2 that only retraces to a 50% retracement of wave 1. Sometimes, of course, we look for the ideal objective, which is a 618 multiple. But there are times when actually we see wave 2 fall back to a 786 retracement of wave 1. Now, as far as our third wave objectives to the upside, of course, we're going to be looking for wave 3 to equal a 1.618 multiple of wave 1. We've also identified instances where wave 3 will equal a 2.0 multiple of wave 1. Then there are times we'll see wave 3 actually travel to a 2.618 multiple of wave 1. Now there are times, of course, when we see wave 4 pull back somewhat shallow, especially when a trend is deeply ingrained, and you'll only see a 236 retracement for wave 4. Sometimes we'll see the 382 retracement, which is ideal. Some instances we'll see a 50% retracement of wave 4 of wave 3. Many times whenever you see wave 4 unfold very sharply, in a very volatile manner, it actually will trace deeply down to a 618 retracement. Then for your fifth wave move, we of course look for the equality. Then at other times we'll see wave 5 equaling a 618 multiple of wave 1. In other instances, we'll actually see wave 5 equal, say, maybe a 1.618 multiple of wave 1. The point I'm trying to make with this diagram and me actually applying the lines here is with so many different lines and so many different relationships, prices are going to hit something at some point, okay? Well, I developed this technique when I was day trading NASDAQ quite extensively a number of years ago. I needed something from my perspective as a trader because as soon as the market opens at 9:30, I'm looking to actually take advantage of short-term intraday trades. Sometimes I'll be in a trade for 3 minutes, sometimes I'll be in a trade for 30 minutes. Simply put, during the trading day, if you're an active day trader, You don't have time to do your extensive analysis, wave projections that I typically reserve for, say, after the market closes, because after the market closes, possibly later on in the evening, that's when I'll spend 1, 2, 3, 4, sometimes even 6 hours actually looking at the analysis of a market. Because remember, as an analyst, what you're looking at is what could happen. Number one, different possibilities, different scenarios. You're weighing the different scenarios. This could happen, this could happen, this could happen. So you spend a lot of time actually performing a number of different calculations, looking at price charts a number of different ways, utilizing your momentum indicators and oscillators to support your conclusion. But during the trading day, certainly if you're a day trader, whether you're day trading FX or if you're day trading, say, the S&P E-mini, you really don't have time to do all of that extensive, in-depth analytical work. You have to have a tool that's simple and effective. And that's where the idea of reverse Fibonacci actually came into play. And this is why I utilize the technique, because it's very simple and it really requires only 2 variables. And the 2 variables that I most often look at are 1.382 and 2.0. That's it. So the idea of utilizing 0.236, 0.382, 0.5, 0.618, 0.786, 1, 1.382, 1.236, 2.0, 2.618, 4.236, 6.859, rather than utilizing a dozen plus different Fibonacci ratios and extensions to identify possible targets, I only have 2. So right there from the get-go, we've actually simplified greatly Fibonacci analysis from utilizing multiple ratios to simply 2, 1.382 and 2.0. These are the only 2 variables. Well, maybe in recent years, I've actually added a third, but these 2 variables will take care of, give you high probability targets or projections 90% of the time, 95% of the time. Now, so what I'm looking at here essentially is a price chart of Pfizer. And let me show you how I utilize the approach. And the logic of the approach is simply based on a very simple idea that the most recent price action is the most relevant price action. Case in point, whenever I came up with this idea, I recently had an automobile accident at an intersection. Well, the next day I had to go through that same intersection to get to work. Well, the next day when I got to that intersection, I was extremely nervous and almost panicky because the prior day I had the accident. I wasn't hurt, nobody was hurt, but at that same intersection the following day, I was very nervous. Well, I found over time that when I would approach the same intersection, my stress or the anxiety would lessen and lessen and lessen. So simply put, the closer an event is in time, the more relevant that event is going to be. The farther away from you are from that event, the less of an effect it will actually have. So in this case here, when I'm theorizing, faulty or not, is that, for example, wave 2 is really more relevant than your wave 1 because wave 2 was the most recent price action or price move within a developing structure. So in this case here, we simply begin by taking one multiple, or looking at one price move, and that would be this decline. This is going to be our measuring decline. So what we simply do is we take that distance, beginning from that low to the high, utilize our 2 numbers, 1.382 and 2.0, and that will identify a high probability objective for our anticipated advance. And as you can see, it did a great job of actually identifying the high right here in Pfizer. One calculation, 2 variables. Let me repeat that. One calculation, 2 variables. Notice there was not the incessant need to go through and perform multiple calculations. If I had the time, I certainly would do that to ideally refine the objectives. But simply put, in this case here, all we did was simply take the distance of this sell-off, this counter trend move, multiply it by 1.382 and 2.0, and we identified 2 objectives. How do we know the market's not going to stop at the 1.382 multiple and continue higher to a 2.0 multiple? Well, from my experience in utilizing the technique, I would probably say about 80 to 85% of the time, probably 85% of the time, you will indeed achieve a 1.382 multiple. About 70% of the time, you'll achieve a 2.0 multiple. I've utilized the technique enough where I have a good feel on the probabilities on how frequently I will indeed achieve a 1.382 multiple, and then also the higher 2.0 multiple. And those, again, those probabilities, just off the cuff or just a rough estimate, would be about 85% of the time, maybe 90, but 85 to 90% of the time, you'll easily achieve a 1.382 multiple. 70% of the time, maybe 75% of the time, you'll continue higher to the 2.0 multiple. Now, can we stop here? I made a big case or a big point earlier in the week about the importance of clustering, Fibonacci clustering, where you perform multiple calculations to identify a tightly bound cluster of either Fibonacci support and or Fibonacci resistance. Well, we can apply the same technique here, but again, the approach would be very simple. For example, what we'll do next is simply identify this decline. That would be another measuring point. So we start here at the low, go to the high, and here we have a Fibonacci 1.382 and a 2.0 multiple. Now remember, there is a third variable I sometimes incorporate, but only about 10% of the time. That's a 3.0 multiple. So that's why you'll see essentially three lines. So what we've been able to do so far is make two calculations and identify a number of high probability areas. Very simple, very effective, and it works quite well if you're, say, for example, again, a day trader of the S&P E-mini or the Forex currency markets, because I find the technique very usable and very effective in those markets as well. So let's go back to this example and I'll just walk you through how I would utilize the technique to begin with. Of course, we're going to do the first multiple here off the prior move. That gives me a great objective of about 35, 39. So let's go ahead and identify that, put our line right here. That's a good high probability objective for the current move. And then we can actually work off the smaller waves. So for example, I want to utilize this move here to identify the subsequent advance. And it really, if you'll notice, I'm not looking to essentially top tick the market here. I want these levels actually to provide high probability trade targets. And what I'm referring to specifically from a trading perspective, I want the market or the move to actually exceed these levels. And the reason why is because I want to make sure I get filled on any kind of exit positions I may have. Okay, so we have this move here that identified, we'll just utilize the 1.382 right here. Nice objective for this advance. Then let's identify this pullback right here. And as you can see, nice 2.0 multiple coming into play right here. Many times you can identify whether or not a market will continue to a 2.0 multiple depending on how it reacts to the 1.382 multiple. Notice how we decisively penetrate the 1.382 multiple right here. Okay, and then we'll of course utilize this pullback to anticipate give us an idea or an objective for the current move up or that move to the final high. So we come back, utilize our tool one more time, and again I'm looking primarily at two variables. Right there is a 1.382, and if we go back to the initial move that we actually saw here, I believe we actually had that 3.0 multiple come into play right there. So what can we, the number of calculations you've seen me perform with just in the last few minutes, just a number of just very minor calculations, but if you actually look at the price chart, here was our first objective, here was our second objective, and here was a third. Each one, I think, in my opinion, was extremely relevant in anticipating a move to the upside and where we'll likely see the market at least pause prior to the next move up. Now, those illustrations and those examples, again, are more easily illustrated in this price chart here. You can just simply walk up and see the relevance of each of the numbers. But let me show you, again, a more simplified approach. This is American Barrick, and again, to put everything in an Elliott wave context, what essentially am I doing the old school way, or the traditional Elliott wave version of applying Fibonacci analysis would be, for example, to anticipate wave 3, we would take the length of wave 1, multiply it by 1.618, 2.0, 2.618, and that would give us an objective for wave 3. And as you can see in this case here, wave 3 came in right at 9.8. We didn't quite achieve that level, but it was a great downside target. We identified an area. Now let's look at the 1.382 approach of the reverse Fibonacci technique. Rather than utilizing wave 1 to anticipate wave 3, essentially I'm utilizing the most recent wave. I'm utilizing wave 2 to anticipate or measure the length of wave 3. So what I'm looking to do is apply the reverse Fibonacci approach to the second wave to identify a likely objective. Now let's look again, let's distinguish the purpose of the approach. Okay, let's say if I was a trader, I'm short the market because I believe in the wave 3 idea to the downside, and I have say a profit target or a sell order in place and exit at where wave 3 equals a 1.618 multiple of the corresponding wave 1. Well, unfortunately, I would be disappointed even though prices traveled very close to that level. We missed it by a few pennies here. We didn't actually trade through that level, so that position was not exited. Where if I utilized the 2.0 multiple for the wave 3 decline, I was able to actually exit the position with a profitable trade. That's another part of the logic that actually goes into the technique where I'm trying to identify precise levels that the market will either encounter resistance or actually preferably trade through to make sure the orders are indeed filled. Then of course, so we utilized our 2.0 multiple to identify the wave 3 price move right here. There we go. And then notice too, we have our wave 3 multiple down here in case things get exuberant. That's what essentially what the 3.0 multiple is for. Now let's look at wave 4. So I'm just simply going to take the length of wave 4, multiply it by 1.382 and 2.0, and that should identify some high probability downside objectives. And as you can see, the tightly bound cluster of support comes into play right here. And we utilized only 2 calculations, just 2. So rather than identifying the 382, 50%, 618, 786 for wave 2, rather than looking at the 1.618, 2.0, 2.618 multiple for wave 3, rather than looking for the 236, 382, 50%, 618 retracements for wave 4, or anticipating, for example, where wave 5 equals wave 1, or wave 5 equals a 618 multiple of wave 1, or wave 5 equals a 1.618 multiple of wave 1. This approach, this reverse Fibonacci approach, is designed to be simple and effective. And what we have essentially have done in this case here is we've done 2 projections, one off of wave 2, one off of wave 4, and as you can see, the end result was quite effective, and that we identified a high probability area for wave 3 to fall to and then reverse from, and then we identified a very appropriate 5th wave move to the downside. Now what we can actually do too is utilize the technique not just simply on waves 2 and waves 4, but you can also apply the technique. For example, if you're trying to anticipate a wave C price move, you simply take wave B. That's going to be your variable to actually work with. Now what's important to also understand is the technique is quite usable on intraday price charts. This is the S&P 500. So let me clean up the price charts, take some of these lines off, and I'll just kind of walk you through the way I would look at this utilizing, again, a Fibonacci, reverse Fibonacci technique. First, what I'd like to do is the prior consolidation, this move up here. Number 1, I want to take the length of wave C. Number 2, I want to take the length of the entire structure. Well, not bad as far as actually pegging the low, but as far as this move here, this is exactly what I'm looking for from a trading perspective. I want to find a level, identify a level that I'm confident that the market will trade through, make sure my orders may be filled, and then we reverse from. So this was a nice area of support here for the market. Now let's continue the analysis and go, for example, the anticipated move up here. Here we have an initial move up, pullback. This looks like a little bit of an ABC, so we're probably working a flat wave B. Now the traditional approach would be to look at compare the links between waves A and C. And as you can see, we have 786 coming into play right here. And then a bit higher, we have equality. Again, multiple levels, and then also to the 618. Well, let's look at it from a reverse Fibonacci perspective to see how we did. What we would do in this case here is simply take this advance, and in my opinion, ideal. This is the trade target for the wave C advance, 1.382. Notice we traded through that area and then reversed. So I know since we traded through the level, any kind of exit orders would be filled, then the reversal to the downside. Well, let's take a look at the reversal to the downside. We can actually apply a number of different techniques here, or just simply, again, two equations. This one here, that prior advance, and then the larger advance to the downside. And again, we're doing somewhat of a little bit of a clustering here. Two calculations, and we identified a nice area of support for the market, 184.94 through 184.19. This is a great area for this market to fall to and then reverse from. Now we can enhance it further by actually looking at the entire larger corrective structure in this market, from that high to the low. And what begins to transpire is, notice we have a very tightly bound cluster here, right around the 175 handle. That might be something to pay attention to in the days to come. Now let's move down to a smaller term time frame chart. How would we work the current move up here? Well, the two levels or two moves I see here that really attract my attention would be this one right here. Let me redo that. So this is the prior pullback to that final high. And then the larger pullback right here as well. And what we've identified, two very tight levels here. Actually, a number of tight levels. Number one, we have this area right here. Notice we're quite near our price gap, and then we have a higher level here, which is more tightly bound, something to keep an eye on in case we do make new highs for the day, right about here. So the whole purpose or logic behind the reverse Fibonacci approach is simplicity. Rather than doing multiple calculations, and again, we all know how many different Fibonacci ratios, retracements, and multiples that we work with as Ellioticians, but more from a practical application in the heat of the battle. If you need a technique which is based on Fibonacci analysis, and as R.N. Elliott stated, he firmly believed that the Fibonacci sequence was a mathematical basis of the wave principle, I couldn't more firmly agree. I believe very much the same thing. That being the case, I really do want to utilize Fibonacci mathematics in my approach to the market in identifying price move, because the Fibonacci ratios, as you well know, govern, for example, growth as well as decay in any kind of a market, whether it's nature or in the financial markets. So I definitely want an approach to the markets which is indeed Fibonacci based, but I need something simple. That's very important. I need something simple that is indeed effective. And my result that I'm offering is this reverse Fibonacci approach. Now, it takes a little bit of practice to kind of understand or identify quickly which levels that you would want to incorporate in your analysis. But the best thing about it is you're really working with two variables roughly about 90% of the time. 1.382, and then beyond that, 2.0. If things get exuberant, of course, you'll want to look at a 3.0 multiple, but rarely do I actually encounter that. I find that the 1.382 and the 2.0 multiples, only two variables, Very, very simple approach, but also very, very effective. Thank you very much, and I'll see you tomorrow for the Traders Classroom live event, which will begin at 11 o'clock. Thank you.